and welcome to the Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thapliyal, and today on the show we'll be discussing about your EMI and your strategy in fixed income going ahead, and we'll be also answering your portfolio queries. So just in case you're watching the show live, do send across your questions on our WhatsApp number, which is 8657974571. You can also email us your questions on themoneyshow@etnow.tv. All right, so let's begin the show. A rate cut in almost 5 years. That's right. The Reserve Bank of India decision to bring the repo rate down by 25 basis points to 6.25%. The first such cut in almost 5 years will help lower interest rates on home loans, bringing down EMI and giving a relief to home buyers stuck with elevated interest rates. Now, the question is, a slight cut in the interest rate can save borrowers a substantial amount that they pay in the form of interest. But when will this happen? Also, how much of a relief are we actually talking about? Is there any other way we can get more relief? And what's the trajectory going ahead? And was this the apt time to cut rates looking at the rupee weakness? Let's discuss all of this. Today I have with me Lakshmi, CEO, Kotak Investment Advisors, and Adhil Shetty, CEO, co-founder, bankbazaar.com. Good evening and welcome both of you. Lakshmi, I'll come to you first. Do you think the right time to cut the rate, or it was just the forced timing for us to cut the rate because we just had to take that step?
Kavita, hi, good evening. I would say that, when the stance changed to neutral, at that point in time, the segue towards a potential easing of interest rates actually was getting created, or I would say a plinth was being set. And now, given the fact that there was a visible decline in inflation, whether you call it food-led or cyclical or whatever, seasonal, whatever the case may be, as long as the headline numbers are decelerating, and in fact, the upcoming data is likely to see the headline number close to 4.5%. As RBI governor said that, look, the monetary policy should be forward-looking. So I think from that perspective, I think it was good to do some sort of a Sri Ganesh, I would say.
And after that, a long wait also, Lakshmi, because a lot is again data dependent now.
Absolutely. So typically what happens is, if you see, the gap between two rate actions has been around 11 months. This time around, it's been almost 21 months. Yeah. So I think it was a long wait, but definitely the gratification or the patience game really worked out.
Adhil, now since the Sri Ganesh has happened, and we will also wait for this Sri Ganesh to translate on our EMIs that will go down, but then how much relief are we actually talking about? If you could just explain us through an example.
Sure, Kavita. So I think it's a double Sri Ganesh, because we got something in terms of the cash back from the finance minister, and now we've got the repo rate cut. Now the important thing, Kavita, like you said, is if you've taken a existing home loan which is on the repo rate, at your next adjustment cycle, and your next adjustment cycle can happen in 1 month, it can happen in 3 months. So they have a reset date for your home loan EMI. Automatically, this benefit of 25 bips is going to flow through to your EMI or to your tenor, and there's no action you have to take. It's fully automatic. The RBI has ensured that. Now, the default option that typically kicks in, right, that the bank will keep your EMI to be the same, but will pull back the tenor. So automatically, your number of EMIs left will go down. I'll give you a practical example so viewers can easily understand it. So let's say you've taken a 50 lakh home loan. Let's say you're paying 8.75%. 1 year has been paid off, 19 years is left. What this 25 basis cut will do to you, right, is it will reduce your tenor by 10 full months. So 10 months less tenor will automatically kick in by default on your home loan. And the amazing thing in the example I'm quoting, which is your 50 lakh home loan, 1 year is paid off, 19 years is pending, you're paying 8.75%, rate has gone down. Effectively, right, your outflow is going to go down by 4.2 lakhs in terms of interest paid. So this is a substantial saving, but the key or the catch to this, Kavita, is continue to pay the same EMI. Let the tenor automatically come down. So the amount of time you're paying for the loan comes down automatically. Now you can also talk to your bank, and the bank will give you the option of reducing your EMI. Now, if you reduce your EMI, right, the benefit actually is less to you. So just to give you an example, per lakh of EMI in that example I just quoted with 19 years left, your EMI will come down by 16 rupees per lakh. So net net, right? If you compare the savings, if you take the lower EMI or you do the default and just take the lower tenor, we highly recommend at Bank Bazaar, let the tenor go down, continue to pay as much EMI as you're currently paying.
The tenure needs to go down, but also, Adil, when will this actually happen? Because this won't be translated immediately, right? We need to wait.
Yeah, so see, it can happen when your loan reset happens. So my home loan, for example, resets every month. So next month I'll get a letter saying that the repo benefit has come to your EMI. Next month I'll start paying less. Now someone else might be on a low loan where the reset is every 3 months, right? So they might need to wait for the end of that 3 month period for the reset to happen. A letter will come from your bank explaining that, or you can look at your loan agreement and it'll explain that. But I want to make one interesting point now, Kavita. So we're talking till now about existing home loan borrowers. A lot of people we know currently are at that 8.75%, 9% range. But there is a opportunity now for new home loan borrowers too. So the current prevailing industry rates, right, are in that 8.4 to 9%. So that will also start to go down now because the repo has been cut, competition will increase. So this is a good opportunity for everyone, both for new home loan borrowers and for existing home loan borrowers. If rates start to go down to that 8.25% kind of range, right, there's a tremendous amount of saving you can make by switching to a lower rate, but maintain your EMI to be the same. So you get the maximum benefit of a lower tenor.
All right. I also want to understand the refinancing option that one might have, because we are just looking at the first rate cut now in so many years, but then how soon it will happen the next time. Let's understand from Lakshmi now. Lakshmi, what are the criterias or triggers or factors we are looking at, for the next rate cut? What is, how is RBI looking at it in terms of inflation, in terms of growth and rupee weakness, obviously?
So I'd say that while the growth forecast broadly was in line with expectations, even the inflation numbers, if you see for FY 2026, has been penciled at 4.2%. Now, at 4.2% means that RBI very theoretically has that elbow room to ease at least another 0.25% from the current levels, which can take a repo rate to about 6% during the course of the next few months. Well, it's too soon to say whether that cut should happen as early as April, or probably it can get pushed into June, because there is a whole host of global factors. And as you rightly alluded to, the rupee has been on a weak innings up until now, in line with the other emerging market currencies. So I think some of that will definitely be a key consideration, apart from the fact that there is a visible cool off in the food prices, which will show up in the headline inflation in the next coming months. So I would say that 6% is what one can expect as the bare minimal repo rate for this year. And if that 4.2 number on the inflation as the next few months go by were to be really in the reachable target, then probably we could shift gears to under 6% also on the benchmark repo rate.
All right. Now, having said that, Lakshmi, let's also talk about fixed income investment option. Now, since we are also looking at more money in our hand, since the budget and the new tax slabs that have been announced, and we are already seeing a lot of onboarding done in the new tax slab, and also the rate cut would eventually give a lot of financial relief for a lot of people. And now we are looking at equity markets being very volatile. If we want to continue our strategy in fixed income or debt, fixed deposit, or any other debt mutual fund, what should be your strategy? Because deposit rates won't be cut immediately as well.
No, so it's a combination. See, fixed deposit, obviously the rate is fixed, but the liabilities typically are floating in nature. So the tendency of that to ease off, as Adhil rightly pointed out, it is pegged to a benchmark rate, and therefore it's a floating rate. So when the repo rate comes down, you tend to start to see the repricing there happen. Maybe not in the same quantum, but definitely it is likely to happen. In the equal breadth is the fixed deposit rates, which also is likely to come down down, though with a lag. So I think a good opportunity in this market would definitely be to, apart from securing some safety in the form of your fixed deposits, it's equally important for you to understand that that will secure you and give you an assured rate of interest. But here, when you invest through debt mutual funds, you also get an opportunity to participate in the upside as and when the yields come down, which is exactly what happened in the last year. So I'd say that look at well managed gilt funds, bond funds, as the case may be, and there are quite a few of them available in the industry today, which are positioned anywhere in the 5 to 10 year sort of a bucket, or even opt for long duration funds. Again, that's a fantastic category when you are looking at the next 2 to 3 years, and the gratification obviously will play over time. But these are strategies definitely worth considering in a market scenario like this.
Bond and long duration funds. What about the interest rate volatility that one might experience in a long duration fund, and or it won't be there, till the time you are logged in for that period?
No, it definitely will be there, Kavita. I think there is something known as NAV, or net asset value, which is released every day on a day-on-day basis. So there will be market vulnerabilities or up and down, which will impact your returns on a given day. But we are building these kind of strategies for the next maybe 6 to 8 quarters, which is 1.5 to 2 years. So I think it's fair to look at it from that perspective, where there can be some capital gains that can actually kick into these kind of strategies over and above the coupon or the carry income that you are earning through fixed income. So I think this combination approach can be possible only when you are parking or you're investing your monies here. As I said, secure some peace of mind through fixed deposits at the high levels, because we expect eventually those rates also to definitely come down.
Right, exactly. Adil, any options for refinancing? Should one be thinking about it?
Yes, this is the perfect time, Kavita. Thanks for bringing this up. So while the repo has gone down 0.25%, I'll come to existing home loan borrowers. What I would say now, right, is the spreads have also come down in the last 2 years on your home loan. There's a real opportunity here because new loan rates will now become cheaper. Today, let me give you an example. There are a lot of people out there who are in that 8.75%, 9% interest range. As the new home loan rates, right, start to go down, you're going to get a potential double benefit. So, your rate is coming down and the new home loan rates are going down. You should think about evaluating a refinance option. I'll just tell you what will happen to someone who's currently paying 8.75, refinancing to 8.25%. So imagine that automatically 8.5 has happened and the 0.25% is the refinance to the new loan. They will save, right, on a 50 lakh loan with 19 years left, keeping the EMI to be the same, they're going to save 7.9 lakhs. This is called a double switch hit benefit that we're explaining to consumers at Bank Bazaar. Search for a lower refinance rate. Remember, if you have 19, 20 years left, a 0.5% saving on a 50-year loan is 7.9 lakhs less in outflow, right? Try and maintain your same EMI. That's the way to maximize your benefit.
All right, I think that will be all great takeaway and actually points for our viewers today. Thank you so much, Lakshmi and Adhil, for being on the show today. Thanks. All right, with that, it's time for a quick break, and post that, let's connect with our financial planner. We'll be having Shweta Jain with us, who will be answering your portfolio queries live.